we start with the market sell-off. Check out the S&P 500 taking out those February lows in the final minutes of trading. We did slightly bounce off that level, but stocks still managing to close at the lowest level in more than a year. Meantime, the Dow dropping more than 500 points, the Nasdaq wiping out its gains for the year, joining the other major indices in negative territory. So as we sink further and further into a correction, are we heading straight for a bear market? Are the bears here to stay, Guy?
Well, the bears here to say hi, Mel, by the way.
Hi. Happy Monday.
Weekend. Yeah. We're right in the window now of the holidays, like 8 days.
Yeah.
That's fantastic.
Let's save the Christmas special for a time when maybe the market's less
when
important.
the market is actually not as big of a
not in turmoil.
So look, I do think I've thought the Fed should move. I think the Fed should move. Karen and I were talking about this, but I can actually lay out a bull case for the market now that the Fed maybe moves and then gets extraordinarily dovish for all of 2019, or even better for the market, they say, you know what? We're not doing anything. We've tested that 25-30 level in the S&P that you just talked about from the February low. So maybe people have gotten themselves so bearish that Wednesday they could get themselves a little bit of a Christmas present early, and this market rallies into the rest of the year. That said, I think the Fed would be making a big mistake by not moving, but I could absolutely see that scenario.
What do you think?
Yeah, I would just add one point there. I think it would be a huge problem for the Fed and for all Fed chairs from here on out if they really do give in to just, down 7% in the market this month, and also the pressure from the president. Because really what they're doing, they're going to be ceding control for a good long time to the president.
But it's not a vacuum.
Why would this be the president? I mean, why wouldn't this just be market factors that are really in the face that say, I get why the Fed is doing what they're doing.
Dot plots still say to go. I mean, so that's all I know. I've been hearing dot plots for 5 years during this whole, period of just extraordinary monetary easing. Now they're tightening. They're sticking to their guns. I think they have to do it. I mean, that's my.
You actually think the Fed should not?
I've actually
raise.
evolved my thinking, meaning I've changed my mind. I've sort of come around to maybe they should not, or the scenario that Guy laid out, one, and very dovish. Very dovish, not locking, not putting themselves in a corner, anything for 2019. I also, you and I were talking about this a little bit. Is it off the table that they make some change to the, shrinking the portfolio?
Yeah.
Right?
The quantitative, the QT.
The QT,
right, exactly.
Right. Is that, so it seems to be, it's not in the conversation ever, it's all about the Fed raising rates or not. I don't know if that's something that could become in play.
I mean, if QE helped on the way up, doesn't QT have a dampening effect?
It sure does. $600 billion. I mean, there's a lot at work here. I think also the Fed could look at, Dan, what's going on in credit markets. And I think if that to me is what's different about what's gone on in the last 3 to 4 weeks. You may have seen the leverage loan index that's out. That's, again, a measure really of high-grade stuff and the activity going on in the space. You can actually look at the FT did a nice highlight of the fact that the high-yield market, which is $1.2 trillion, has had zero issuance this month. And if it goes to the end of the month, that will be as bad as it had, or the last time it did that was November of 2008. High yields at 2.5-year lows. We haven't seen, at the start of a credit cycle, possibly no sign of the impact of fallen angels or credit downgrades yet. That's a little rare for where we are right now on the verge of a cycle. So credit concerns me.
Let me just add one more thing about that piece today, the op-ed piece, Stanley Druckenmiller, also written by Kevin Warsh. I was sort of wondering if it was somehow Kevin Warsh throwing his hat into the ring again to be the Fed chair, right? We know that Trump really doesn't like Powell. I'm not saying this is, likely, but it just, that was the first thought in my mind, saying, hey, I will be more dovish. Right. Not that I think Powell's bad. I don't.
Can we all agree, though, in the last 10 years, when markets and our economies have been very reliant on central bank policy, specifically our Fed in particular, that the markets do not like surprises? And I think it would be a huge mistake for Jerome Powell to diverge too much from what the expectations are. Right now, Fed funds is pricing a 68% chance of an increase of 25 bips this week. So, why do they want to go out and surprise anybody? There's this public debate going on right now, very public debate. So it just doesn't make any sense to surprise them.
What about this and something very, very hawkish, but dovish in terms of what they lay out for next year?
There's not going to be anything that's very, very anything. It may be a little more dovish than it was. It was just like the statement that he gave that they're closer to neutral than they were a long ways from neutral. They just tightened up that language.
Here's the question. I mean, if everybody and their brother is now saying one hike and then a pause or some sort of dovish hike, right?
Right.
What's What's the market response to that? I
Well,
mean, if the markets are sort of anticipating that, do you think we'll get a pop
Well, I think
on the back of that?
Built into this conversation, I think none of us are saying this, but I think there's this belief that the only reason the market's gone down since October is because of the Federal Reserve. I don't think that's true, by the way.
I don't think it's true.
I don't think it's true at all. But I think a lot of people believe that. And if you look at Twitter, if you read a lot of things that are out there, a lot of people think that but for the Fed, this market would be making new highs. I'm not one of those people. But to answer your question, I think if they were to take a more dovish tone, given what we've done, given the levels that we tested today, given the fact that now the VIX is around 25, you could set yourself up for a pretty nice rally into year end. I think that's a rally that should be sold and will be sold, but that's how it's setting up to me into Wednesday.
Yeah. I still think trade, though, is the #1 issue facing this market. And I don't know that we'll get any kind of improvement over the next, 2 weeks.
By March 1st.
Right. I don't even know if we'll get improvement by then. I don't know, is it February 1st or March? Whatever. Anyway, that to me is still the biggest issue out there because it's such uncertainty. And that follows through to companies sort of making their projections way more than a quarter point of hike.
What I'll say is we're definitely not at risk of going into higher gear in this economy. And in fact, if anything, there's people that are starting to talk about where we are coming into the first quarter of next year. The bottom line is the impact on S&P earnings is really all that matters for equity markets, that and the credit side, which I think equity markets are still not discounting enough. And to say that we should be unchanged on the expectations of where we were for S&P earnings even a couple months ago, that does not take into account not only the bearishness that we've heard from the C-suite, but the fact of the matter is we have heard some major negative headwinds from around the world, which I think are important.
Okay, so here's the question. Are we headed to a bear market? Earlier today on the halftime report, bond king Jeffrey Gundlach of DoubleLine had a warning for the markets.
I'm pretty sure this is a bear market. I mean, people like this definition of 20% down as a bear market, but that's obviously very arbitrary. I've been around for over 35 years in this business, and I've seen a number of bear markets, and it's more about kind of how you lead into it, how it develops, and how the sentiment changes. And I think we've had pretty much all of the variables that characterize a bear market.
What do you think, Dan?
Yeah, so I would just say from the price action, I've been around for a little more than 20 years, and I've seen 2 bear markets. And the one that happened in 2002, the bottom in 2002, really in October 2002, was pretty bad. It was long, and every rally got sold. There were some amazing rallies in it. In 07, 08, it was really a response to a major crisis. And I think there's 2 really important differences here. So could we bang around and get ourselves back to 2000 in the S&P over the next year without a crisis? Yeah, that would feel like a bear market. It would feel a lot like after the exuberance of the late 90s. And I think that could be a healthy thing after we've had a 10-year bull market for all intents and purposes.
Yeah, I just don't think that the market is treating the current environment and think of all the disparate but very important exogenous factors to just S&P earnings that are causing this. I think the market is trying to figure out whether there is this crisis moment out there. Because, again, while the U.S. banks are as healthy as they've ever been on balance sheet, and I want to be clear about that, I'm not worried about U.S. banks per se. I am worried about net debt to EBITDA across the entire corporate sector. And frankly, I'm very worried about Europe. I just think Europe, we have not even begun to even fix the problems of the last credit cycle. And in fact, we're a headline away from a lot of political discomfort.
I mean, I agree with Gundlach in that. Saying bear market, it's sort of arbitrary, right? 20, it's a nice round number. But at the same time, investors at home, basically what they want to know about 2019 is it going to be easier or is it going to be harder to make money versus 2018? What is the investing environment going to be?
2018's been far from easy.
Right, exactly. Right.
I know you
so is it going to be easier or harder? Is it going to be a tougher environment? Is it going to be as hard? I mean, when every single asset class finishes a year lower, is it going to be easier or harder?
Well, if every single asset class finishes the year lower, it must therefore be only as hard or easier, right? You can't have more than everything. But let me ask you, what is a bear market? It's 20% down, but what else is it? Is it that every rally is sold? Is it that good news, it doesn't matter? Is it that, I mean, is that what you're talking about? I'm not sure.
Technically, it's just down 20%.
That's it. Okay, but there's a lot more to it. That sentiment and liquidity leaving the market, that makes them.
I think also, Dan's point is also that relative to where we've come from, I mean, we're only 13% off the top on the S&P, folks. This feels a lot worse. It is a lot worse below the surface. And relative to where we've come from, you can make an argument that this is still a correction, even though there's no question that the sentiment is so awful across every space other than S&P outlook and S&P earnings outlook.